Heavy is the head that has to manage all of this.
Hey everyone, welcome back to my channel.
We're now incentivized to buy what we already buy.
Fumbling through college had me building.
I also got some done on the other side.
And that was right around, I would say, May maybe, right before renewing the lease for this property.
Welcome to the channel, Martha.
Thank you for having me here.
Oh, I was going to say, I am getting up there and age, I'll tell you what.
Bills paid by other people, life was never this good. I had to step back.
Hey everyone, welcome back to the channel. So today I'm going to talk about a lot of the questions that I've been getting on Snapchat, on Instagram, and in person as well. And I'm just going to address it all today. So this is actually going to be one of the best videos for all of you who had questions for me, who have been writing down in the comment section down below. If I missed something, please make sure to put it down in the comments as well. I'm going to go with the most frequently asked questions, and then we're just going to continue to spin roll into some other stuff. So the first thing that I get asked a lot is, hey, what should I invest in? So before we even start with the investing process, we need to know what you are passionate about. And a lot of the times, you know, we start off in the stock market because the stock market is the easiest gateway to entry, believe it or not. And so with the stock market, when you start to look at stocks, the first thing I want you to do is I want you to think of every single company that you absolutely love and write it down on a piece of paper. So if that's Best Buy, if it is Nike, if it is Walmart, if it is Google, Amazon, Netflix, write it down on a piece of paper, every single company. Look around your house. Look at the things that you wear, Gucci, Rolex, Louis Vuitton, whatever it is. Start to write it down, right? And then once you write it down, the first thing I want you to do is look at their 5-year graph and chart. Are they profitable? Are they more than 130% profitable? The second thing I want you to do is look at their 1 year. 1 year to me doesn't matter as much. It can be down, it can be up. If it's down, that means it might be a good buying opportunity. If it is up, not much research is needed because you can see that they're on an upward trajectory from that 1 year and 5 year. But if it's down, you're gonna need to do a little bit more digging before you buy that discounted stock, because it might not be discounted, it might actually be down for a reason. So you want to go ahead and start looking at the news, look at the research behind it. A lot of the time, Yahoo Finance is gonna have some research on it. Robinhood, if you use that app, is going to have some research on the stock and why it's down right now. You know, a lot of the stock is gonna put out, the company is going to put out statements. Maybe their quarterly earnings report was bad. You want to look at that as well. And so once you've done that, once you've done the research, you also want to look at their 52-week high and their 52-week low. This is going to let you know whether you're buying towards the bottom or buying towards the top. I never really like to buy towards the top, especially if the gap from the 52-week high is $30 or more. I figure it will probably go down a little bit, and I don't want to buy $3 towards the top, knowing that I can probably get in at a more discounted rate in a week or two. Now, I'm not telling people to wait. Obviously, get in when you can, but what has worked for me is just waiting a little bit and getting in on that low $7 range. If the low is like $30 or more, trying to get at the bottom of that $7 range has typically been best for me, and that has allowed me to get a lot of profits. Now, if they had just recently hit that 52-week high and they've never been there before, it is very unlikely that they're going to go all the way back crashing down. But it does happen, and if it does happen, you want to buy more to lower your position from that high. So it's basically like dollar cost averaging into that stock in order to lower that position so that you're not so close to the high, and once it goes back up, you're able to ride that all the way to the top with more money growing on top of that money. And so your selling point, if you do decide to sell, is a lot cheaper than it was before. Now, that is a lot of high level information, but it is important for me to stress that. You also want to know whether, if it's an ETF, what is their debt ratio, right? So or their cost ratio, basically what you're going to pay for owning a stock. For example, the S&P 500 has like a 0.003% cost expense or expense ratio. So you got to pay that every single quarter, right? But their dividend percentage is like 2%. So that's going to cover the expense ratio, and you're going to get a dividend payout on top of that. So in my case, I like low expense ratios when it comes to the ETFs, your exchange traded funds, but I absolutely hate expense ratios that are more than 0.005%. Even 0.015% is way too high for me. I absolutely hate expenses because that also compounds and that eats into your profits. So you want to limit expenses as much as possible. And so that's why I don't really have a lot of ETFs in my portfolio. I do have like 3 Vanguard ETFs and then S&P 500. So about 4 ETFs, and no, 5, because I also have NOBL in my portfolio, which is the Dividend Aristocrat ETF. Now, these exchange traded funds, you can look at the companies within their portfolio and just simply buy those companies, and therefore you will not need the exchange traded fund. So for example, instead of buying NOBL, you can just buy the companies within that exchange traded fund by Googling NOBL and looking at the companies that they hold, right? So when you see the companies that they hold, you can just buy the specific companies and you have no need to buy NOBL. And therefore, you won't have to pay the expense ratio. But the exchange traded fund essentially does the work on your behalf, right? Because they have purchased all these companies and put it into one, you're basically buying NOBL, which buys all of those companies. So they take that pressure off of you in having to manage all of that. If you don't believe that their cost for that is sufficient or acceptable, then of course you can always do it on your own and monitor it yourself. It's completely up to you. So moving on to the next one. The next one is what you should be doing first is how do you make a budget and how do you get out of debt? Well, how I make my budget is first by listing all of my expenses. So I start with the mortgage. I start with both mortgages. I start with then how much gas I have to put in my car on a monthly basis. Then I go into how much food do I eat and how much does that cost me on a monthly basis. Then I go into how much am I spending online on miscellaneous expenses, because we do want to cut that out if it is too much. Then I go into the utilities of the home. Then I go into my phone bill for the month. Then I go into internet as well. And then I start to look at other things like I don't factor in the cost of repair and maintenance. I used to do that a few years back, but because my emergency fund is just ridiculous at this point, I no longer have to factor in repairs and maintenance. And then I factor in the cost that I am still wearing braces until November, and so that's costing me $500 a month. And so you just add that on in there, and then you kind of make up your spreadsheet there. And so after that, I start to tally all of my profits, right? So we're going to take in rental income. We're going to take in work income. We're going to take in passive income. We're going to take in all of these things in different businesses. We're going to put it down here. We're going to tally it out. We're going to see how much we make after taxes. And then we're going to subtract that from my expenses. And that's when I start to add saving. Okay, $1,000, $2,000 here. And then investing, okay, another $500, $700 here. And then principal pay down. I already added that to the mortgage because I almost incorporate that together. Hey, I'm going to pay this principal down by X, Y, and Z amount. And so by the time I'm done doing that, I can look around and say, this is how much excess cash I have before going out. before thinking about dates, before hanging out with coworkers, before driving to a family member's house and spending additional gas money, before thinking about gifts and Christmas shopping and birthdays and traveling on vacation, I'm going to think about how can I start to pay off these credit cards. Everything on minimum payments, and then start working on the cheapest credit card that you have and start to knock that out. I don't care which one has the highest interest rate. I just care that it's not going up every single month, because what we're going to do is we're going to start to maintain the credit cards, and then we're going to start to work down the credit balances on the smallest ones and basically eradicate it. And then we're going to add that money into the next one, eradicate it, eradicate until you have no more left. Now, Dave Ramsey is someone who is a promoter of that method. They call it the snowball method. I also do believe that if you can consolidate the debt to a cheaper interest rate, that is absolutely okay, but you have to be smart about it. Most people would tell you not to do this, or some people would tell you not to do this, because it almost takes away from your ability to say, hey, I am going to try my best to get out from under this thing, because you're not seeing the payoff. You're not seeing how you're eradicating it instantly, but instead is broken from it being broken into pieces is now just this one big payment that is going to take a lot longer for you to clear, rather than had it just been separated, it would have been a lot easier for you to clear. I can see that, because if you had killed all those other payments, now you just have more money to put into smaller debts, and then as you eradicate it, everything just looks smaller over time, and you have less balances all in all. But when you have this one big payment, you're not seeing the clearing of all of these debts, and so it can be so much more daunting because of that. Even if the interest rate is smaller and it costs you less, you'll be paying on it for longer because you have all of this combined debt now. Another thing that I can think of that would be very, very helpful is consolidating that into a mortgage, because you're already going to have to pay your mortgage, you're already going to have to pay your rents, and consolidating that into a mortgage is sometimes a good option. Now, when interest rates were 3% and 2%, I would have said that is a great thing to do. It was a great time to do it. Now that it is 7%, the cost of doing so is just so expensive, especially for those who had a mortgage at 3, 4, or even 2% interest rates. So for you, if you have a 6 or 7% interest rate on your house currently and you are in debt, then you can possibly consider refinancing, because the interest rate is basically the same and you get out from under all that credit card debt. The problem is that if you're not financially responsible, you can end up in the same place. And so that should be a last resort. It should not be your first go-to method to refinance that debt. I would prefer you do the snowball method that Dave Ramsey prescribes, because I believe that that is the best for you. Another myth that I want to dispel is that people should not hold on to credit card debt month over month, even if they're not paying any interest on it. There's no reason for you to have extra debt laying around on your credit card. Get rid of it. I have an 800 plus credit score, and I never ever carry debt to the next month. So I do not know where people heard this misinformation, but please, please, please get rid of that stuff. And you already know, if you watch my other videos, that I am no scaredy cat. I will show you my credit card statements. I will show you my credit score at all times. And so I have no problem showing where my credit score is at. I've showed it twice already on this channel, and most likely it won't be the last. So do not believe what you hear about having to carry a balance over the next month. That does not benefit you in any way. Pay down your debts, keep your credit percentage and usage rate under 6%, and use your credit cards, but have the money to pay it off immediately, or don't use it at all. If you can't buy it with cash, don't buy it on a credit card. Understand and understood. Now, one of the last things that is always asked of me is in the real estate realm, and that is regarding multifamily real estate. Now, in my honest assessment, I have only bought in single family real estate. I am looking at multifamily this time around, and I had people who do multifamily. My uncle does multifamily. Some ladies that I used to talk to do multifamily. And so I've definitely been around multifamily units. It's really no different than buying a single family home. And I know every single mortgage out there, outside of state-specific mortgages that might be specific to your state and hometown, that may offer incentives and discounts that I'm not privy to. But in the real estate space, frequent questions that I'm asked is, do I need to put 20 to 25% down on the multifamily? The answer is yes, unless it is a primary residence for you. For a first-time home buyer, it will be very easy to get into a multifamily home and to say it is your primary residence. For someone like me who has single-family homes already, it is more difficult to pass that off as a primary residence. However, it is not impossible. There are many lenders out there who will still lend to you and have that as your primary residence. However, there are some lenders that are going to be more strict and say, because you already have single family homes, we don't see why you would want to move into a multifamily property. And so this is hard for us to wrap our heads around, and therefore we cannot approve you of this loan. Think unless it is a rental and not a primary residence. Now, I had one bank tell me that before, that hey, because you already have single family properties, this multifamily property has to be a rental. It cannot be a primary residence. But most banks will not do that. Most lenders will not do that. Most lenders will say, you qualify for a primary residence on this multifamily, here you go, it is yours. So the truth of the matter is that lenders will tell you that nobody else is going to put this as your primary, and they're absolutely wrong. You can absolutely make this a primary residence if you decide you want to live in it. And the reason why I'm talking about primary residences is because it's cheaper in terms of cost or gateway to entry. You only have to put 3.5% down, including your closing costs, instead of 20 to 25% down if it was a rental, including closing costs. So it is much cheaper to do the primary resident route, and the interest rate is going to be better for you if you make the multifamily your primary residence instead of a rental property. Now, some people want combinations or complexes, and those are going to be commercial real estate that is more than 4 units. So as soon as you pass a fourplex, as soon as you pass a 4-unit property and you get into that 5-unit space, you can no longer mark this as a primary residence. It is now considered commercial real estate, and therefore you're going to have to pay 20 to 25% on that as a rental, because nobody's going to say that you want to live in all 5 of these units. And so at that point, there's no getting around it. You're going to have to pay that 20 to 25% plus the down payment, plus the closing costs in order to enter that property. You can look for certain grants. You can look for partners to partner with you. I personally do not have a partner. I buy all my investments myself. But when it comes to commercial real estate like that, if the deal did present itself that I was super excited about, I would be more than happy to enter a partnership in order to get it done with someone that I trust, believe in, and that has equal, if not the same or more respect for me within that deal, and is structured properly and soundly. And of course, lawyers would have to be involved. So commercial real estate can be a lot more expensive, especially when you have to involve another party. So with that being said, there's no way around it once you hit that 5-unit mark. But if you're staying with 4 units or under, fourplex, triplex, duplex, or single family, you can absolutely make it a primary residence up to five primary residences. And all you have to do is stay in there for 12 months and then go ahead and get you a new one. Again, 3.5% down is going to be FHA loan approval, and then 5% down for conventional loan approval. So you can absolutely do that. FHA is a lesser gateway to entry. Your credit score can be like a 640. I've even seen some 620s. And then for conventional, you're going to need at least a 640 with some banks, and then a 680 with most banks. So I believe Chase Bank offers conventional loans at like 680. So if you have that 680 credit score, you'll most likely qualify with almost every single bank. So if you like this video, make sure you leave a like, comment, and subscribe to the channel. You know I post every single day at 8 a.m. daily on YouTube and on Rumble, and I can't wait to see you in the next one. Peace.